December 27th, 2024. A Friday that will be remembered in financial history. Silver didn't just break $80. It shattered a defense system that took institutional banks 3 years to build. $75 was supposed to be the ceiling, the line they defended with billions in derivative positions. But in 72 hours, everything changed. Trading desks in London went silent. Risk managers in New York began emergency weekend calls. Because the math just stopped working. When a sell wall this massive collapses, it doesn't create a rally, it creates a cascade. And what's coming next? Welcome to Boring Currency, the channel where we analyze what the financial news won't tell you. Now, if you've been watching markets long enough to remember when silver last attempted this level, if you understand that some market moves aren't just technical, they're structural, then you know this channel delivers the analysis serious people need. Do us a favor. Hit that subscribe button, not because we ask everyone, but because you recognize intelligence when you see it. And before we begin, drop a comment below. Tell us where you're watching from. New York, London, Singapore, Mumbai. Because what happens in silver markets doesn't respect borders. And neither does the capital that's about to move. Now, let's talk about what just broke. On the morning of December 27th, 2024, traders across 3 continents opened their screens to a number that wasn't supposed to exist. Silver had crossed $80 per ounce, and it wasn't retreating. For years, market veterans had watched silver approach this level, only to see it hammered back down within hours, sometimes within minutes. The pattern was so consistent that traders gave it a name, the $75 sell wall. But this time, something was different. The wall didn't just crack, it vanished. To understand what happened, one must first understand what a sell wall actually is. It's not a metaphor. It's a documented trading structure built by major commercial banks. These institutions hold massive short positions in silver futures. A short position is essentially a bet that prices will fall. When someone shorts silver at $70, they profit if it drops to $60, but they lose if it rises to $80. And the losses aren't small, they're exponential. For the past 3 years, every time silver climbed toward $75, the same pattern emerged. Massive sell orders would flood the futures market. The volume would be enormous, far larger than normal trading activity. These weren't retail investors selling. These were institutional players defending a line. The Commodity Futures Trading Commission publishes data every week. It's called the Commitments of Traders Report. This report shows who holds what positions in commodity markets. And for years, it revealed the same story. A small number of commercial banks held concentrated short positions in silver, positions so large that if silver rose too far, too fast, the losses would be catastrophic. So they defended $75 like a fortress. Until December 27th. What made this breach different wasn't just the price, it was the timing. December 26th was Boxing Day, a holiday across much of the world. Trading desks in London were operating with skeleton crews. New York banks had sent their senior traders home for the long weekend. Liquidity was thin, volume was low. Normally banks use these quiet periods to push prices down. Low volume means less resistance. A few large sell orders can move the market significantly. But this time, the strategy backfired. Because while Western traders were on holiday, Asian buyers were wide awake, and they saw an opportunity. Physical silver buyers in China, India, and Singapore noticed something. With senior risk managers away, with algorithmic trading systems running on autopilot, the door was unguarded, so they walked through it. Buy orders began flowing in, not speculative paper trades, actual purchase orders for physical metal, the kind that require delivery. And when you demand physical delivery on a futures contract, someone has to produce the actual silver. The banks who had been selling paper contracts suddenly faced a problem. They didn't have enough physical metal to deliver. At $76, the squeeze began. Options contracts at the $75 strike price suddenly became valuable. Market makers who had sold these options were now obligated to hedge. Hedging means buying the underlying asset to cover your risk. So they started buying silver futures, which pushed the price to $77, which triggered more options, which required more hedging, which drove the price to $78. This is called a gamma squeeze. It's a mathematical feedback loop. Each dollar higher triggers forced buying, which pushes the price another dollar higher, which triggers more forced buying. By the time London desks realized what was happening, silver was trading at $79.50. Emergency calls were made, risk committees convened via video conference, but the mathematics had already taken over. At 2:47 p.m. GMT, silver crossed $80. The 3-year ceiling had become dust, and the weekly chart told an even more dramatic story. The candlestick pattern showed something technical analysts call a breakout with conviction. Silver didn't just touch $80 and fall back. It closed the week at $80.35, at the absolute high of the range. This meant buyers were willing to hold positions through the weekend. They weren't afraid of a Monday morning smash. They were afraid of being left behind. Because everyone who understands market structure knows what comes next. When a heavily defended resistance level breaks with this kind of force, when short sellers are trapped underwater, when physical delivery demands exceed available supply, the real move hasn't even started yet. What traders witnessed on December 27th wasn't the climax. It was the trigger. And the cascade it set in motion was just beginning. There's a truth about modern financial markets that few dare to speak aloud. Prices aren't always discovered. Sometimes they're constructed. To understand what broke on December 27th, one must first understand what was built and who built it. The story begins not in 2024, but in 1980, when silver reached $49.45 per ounce. The Hunt brothers, Texas oil billionaires, had attempted something remarkable. They tried to corner the physical silver market. They bought futures contracts, then demanded delivery of actual metal. By January 1980, they controlled nearly half the world's deliverable silver. The price exploded, banks panicked, and the system responded with force. The COMEX exchange changed the rules overnight. They implemented Silver Rule 7. It prohibited new long positions. Only selling was allowed. The Hunt brothers were crushed. Silver collapsed from $49 to $11 in weeks. The message was clear. Challenge the system's control over precious metals prices, and the system will change the rules to protect itself. But the real lesson wasn't about the Hunt brothers. It was about what came after. The financial institutions learned something valuable that day. They learned that physical delivery was the Achilles heel, so they built a new system, one where paper could control physical, where a fraction of actual metal could dictate the price of all of it. Enter the derivatives market. By the 1990s, silver futures trading had evolved into something extraordinary. For every ounce of physical silver in existence, there were hundreds of ounces represented by paper contracts, futures contracts that promised delivery, but were almost never actually delivered. Most contracts were settled in cash, or rolled forward to the next month. This created an illusion of supply, a paper supply that dwarfed physical reality. The Commodity Futures Trading Commission's own data revealed the structure. By 2020, 8 commercial banks held short positions, representing over 300 million ounces. That's nearly half of annual global silver production, concentrated in the hands of 8 institutions. When prices began rising, these banks would simply add more short contracts, flood the market with paper sell orders, create the appearance of massive supply, and watch the price retreat. The genius of this system wasn't complexity, it was simplicity. Most silver buyers never took physical delivery. They traded ETFs, exchange-traded funds that claimed to hold silver. But the fine print told a different story. Many ETFs held unallocated silver, meaning the buyer owned a claim on silver, not actual specific bars of metal. 10 investors could own claims on the same bar. As long as they didn't all ask for delivery at once, the system worked perfectly. Banks could sell paper silver they didn't own to buyers who would never demand delivery, and the price could be managed within acceptable ranges. But this architecture had a fatal flaw. It required trust. Trust that buyers would remain satisfied with paper claims. Trust that physical demand would stay manageable. Trust that no one would challenge the system. By 2022, that trust began eroding. Central banks worldwide were printing currency at unprecedented rates. Inflation was rising, and sophisticated investors started asking uncomfortable questions. Questions about counterparty risk. Questions about whether their silver ETFs actually held metal. Questions about what happened if everyone demanded delivery at once. The banks responded by reinforcing the $75 ceiling. Every approach to that level was met with aggressive selling. Algorithmic trading systems were programmed to defend it. Options contracts were structured to keep prices contained. The system deployed what traders call max pain, keeping prices just low enough to expire the maximum number of call options worthless, while just high enough to avoid triggering mass physical buying. This wasn't market manipulation in the crude sense. No smoke-filled rooms, no conspiracy. Just sophisticated market participants using legal tools to manage risk, and manage meant control. But control requires energy. The more pressure builds, the more energy required to contain it. And by December 2024, the pressure had become extraordinary. Industrial demand for silver was surging. Solar panel production required massive quantities. Electronics manufacturing was expanding. Medical applications were growing. Meanwhile, new silver mine production had plateaued. The gap between supply and demand was widening. And into this gap stepped a new type of buyer. Sovereign wealth funds from Asia and the Middle East. They weren't interested in paper claims. They wanted physical metal, delivered to sovereign storage. Beyond the reach of Western financial system rules, these buyers didn't trade on margin. They paid cash, and they didn't care about short-term price fluctuations. They were building strategic reserves. For them, silver wasn't an investment, it was monetary insurance against a system they increasingly distrusted. When these buyers encountered thin holiday liquidity on December 26th, they didn't see risk, they saw opportunity. The algorithms designed to defend $75 weren't programmed for this scenario. They assumed rational profit-seeking traders, not strategic buyers with unlimited capital and multi-decade time horizons. The machines kept selling, the sovereigns kept buying, and the mathematics eventually reached a breaking point, because every short position is also a promise to deliver silver at a certain price, and when the price breaks through your ceiling, those promises become liabilities. Liabilities that grow with every dollar the price rises. What the banks had built over decades, a sophisticated architecture of price suppression, collapsed in 72 hours, not because it was poorly designed, but because the assumptions underlying its design had fundamentally changed. The question facing markets now wasn't whether the wall would be rebuilt, it was whether it could be. There's a moment in every financial crisis that historians later identify, the moment when containment becomes impossible, when individual problems transform into systemic contagion. December 27th, 2024 wasn't just a price breakthrough. It was the beginning of a cascade. And cascades don't follow linear paths, they accelerate. To understand what's unfolding, one must understand a basic truth about modern banking. Banks don't operate in isolation. They're interconnected through a web of derivative contracts, counterparty agreements, and shared risk exposures. When one institution faces a crisis, the shockwave travels through the entire network. Consider what happened in the 72 hours after silver crossed $80. Bank A held massive short positions at $75. Those positions were now losing $5 per ounce. On a 50 million ounce position, that's $250 million in losses. But Bank A had sold those positions to Bank B, who had hedged them with Bank C, who would offset them with Bank D. Each connection represented a point of failure, a domino waiting to fall. The first domino fell on Saturday morning, when Bank A's risk management system triggered automatic margin calls. Margin is the collateral required to maintain futures positions. When prices move against you, you must post more margin, or close your position. Bank A suddenly needed to come up with $400 million in additional collateral. On a weekend, when markets were closed, this created what traders call a liquidity event. Bank A started making phone calls to credit lines, to counterparties, to anyone who might provide emergency funding. But here's where the cascade intensified. Bank B, who had taken the other side of Bank A's trades, suddenly faced its own crisis, because if Bank A couldn't meet its margin requirements, Bank B would have to close out those positions at current market prices, which meant buying silver at $80 to cover contracts sold at $75. This is called forced buying, and it's the nightmare scenario for any short seller, because forced buying drives prices higher, which triggers more margin calls, which forces more buying, which drives prices even higher. The feedback loop had begun. By Sunday evening, the COMEX exchange faced an unprecedented situation. Monday morning would bring the opening bell, and with silver futures already trading $5 above where major banks needed them, and the exchange had three options: let the market function freely and watch potential bank failures, implement emergency position limits to prevent further damage, or invoke force majeure and suspend trading entirely. Each option carried catastrophic implications. But the real crisis wasn't just in futures markets. It was in the physical delivery system. Here's what few outside the industry understand. COMEX warehouse inventories had been declining for months. Total registered silver available for delivery had fallen to 45 million ounces. Meanwhile, open interest in futures contracts represented claims on over 900 million ounces. That's a 20-to-1 ratio. 20 claims for every ounce of available metal. This worked fine when only 2% of contracts demanded delivery. But December was different. Industrial buyers who had been waiting for years, sovereign funds building strategic reserves, institutional investors losing faith in paper claims, they all wanted physical metal. Delivery notices for January contracts had already exceeded 15 million ounces. That's 1/3 of available inventory. And February contracts were showing similar demand. The mathematics became brutal. If even 10% of contract holders demanded delivery, the system would run out of silver. Not eventually, within weeks. Warehouse managers in New York and Chicago began emergency inventories, counting and recounting available bars, because the question everyone was asking was terrifying in its simplicity. Where would the metal come from? Some suggested the London vaults, but London silver was mostly allocated, owned by specific institutions who weren't selling. Others pointed to ETF holdings, but liquidating major ETFs to supply futures delivery, would trigger a crisis of confidence in all paper silver vehicles and confirm what skeptics had been saying for years, that paper claims vastly exceeded physical reality. The Bank for International Settlements quietly convened a conference call. Representatives from central banks across G7 nations. The topic wasn't officially announced, but insiders knew they were discussing intervention options. Because if silver markets collapsed into chaos, gold would be next. And if faith in precious metals paper markets evaporated. What did that say about faith in paper currencies themselves? This was the real cascade. Not just silver prices rising, but the entire architecture of modern monetary confidence. Being tested in real time. Meanwhile, in trading rooms across Asia, a different conversation was happening. Traders in Shanghai, Mumbai, and Singapore were calculating something else. They were calculating how much higher silver could go. If forced buying continued, if physical delivery demands persisted, if the Western banking system proved unable to supply metal. Technical analysts pulled up historical charts. The 1980 peak of $49 adjusted for inflation was over $180. Silver's all-time high in real terms had never been challenged. If this truly was a structural break, if the suppression architecture couldn't be rebuilt, then $80 wasn't a ceiling, it was a floor. And what came next wasn't a rally, it was a revaluation. By Monday morning, 3 major banks had requested emergency credit facilities, 2 commodity trading firms had suspended silver operations, and 1 major ETF had quietly changed its prospectus, adding language about potential delivery delays in extraordinary circumstances. The legal teams knew what was coming. The risk managers knew what was coming. The question wasn't whether the cascade would continue. The question was how far it would go before someone found a way to stop it, or before the system simply ran out of metal and forced a settlement that would change precious metals markets forever. Because when a cascade reaches critical velocity, when institutional panic replaces rational calculation, when the mathematics overwhelm the politics, the only way out is through. When the architecture collapses, when the cascade accelerates beyond control, there comes a moment of clarity, a moment when business leaders must make decisions, not based on what they hope will happen, but on what the evidence suggests is already in motion. That moment is now. The question facing serious investors isn't whether to pay attention, it's how to position for what comes next. And positioning requires understanding something fundamental. Silver at $80 isn't the story. It's a symptom of a much larger transformation, a transformation in how markets value real assets versus paper claims on those assets. For decades, the financial system operated on a simple premise. Paper was as good as physical. A claim on gold was equivalent to gold itself. A futures contract for silver was the same as holding the metal. This premise allowed massive leverage, massive speculation, and massive control over price discovery. But December 27th shattered that premise. It proved that when stress enters the system, paper and physical diverge, and they diverge violently. So the first strategic decision any business leader must make is understanding the difference between speculation and insurance. Speculation is buying silver because you think it will go to $100. Insurance is holding silver because you recognize systemic fragility. Speculation seeks profit. Insurance seeks preservation. And in moments of structural transition, preservation matters more than profit. Because profit means nothing if your counterparty fails, if your bank freezes accounts, if your ETF suspends redemptions, if your paper claim becomes worthless. This leads to the second critical distinction: physical versus paper exposure. Not all silver investments are created equal. A futures contract is a promise, an ETF share is a claim, an unallocated account is an IOU, but a physical bar in a secure vault is an asset that exists independent of any institution's solvency. The events of late December revealed something crucial. When delivery demands exceeded supply, the paper market fractured, prices for physical metal began trading at premiums, sometimes significant premiums, over the futures price. This phenomenon has a name: backwardation in the physical market. It means people are willing to pay more for immediate possession than for a promise of future delivery. And it signals one thing: trust in the paper system is breaking down. For businesses that depend on silver industrially, electronics manufacturers, solar panel producers, medical device companies, this creates an urgent strategic problem. If you've been relying on just-in-time delivery from paper markets, you may soon face supply disruptions. The solution isn't pleasant. It requires capital allocation to physical inventory. Stockpiling metal when prices are rising feels counterintuitive, but waiting until supply chains break is catastrophic. Some of the world's largest industrial consumers have already made this shift, quietly building 6 to 12-month reserves, securing supply agreements directly with miners, bypassing the paper markets entirely. This behavior creates its own feedback loop. Industrial hoarding reduces available supply. which drives prices higher, which incentivizes more hoarding. It's a cycle that doesn't reverse easily, but the implications extend beyond industrial users. Investment portfolios built on traditional 60-40 models, 60% stocks, 40% bonds, are facing a recalibration moment because both stocks and bonds are paper assets, claims on future cash flows, denominated in currencies whose purchasing power is uncertain. Financial advisors trained in modern portfolio theory were taught that precious metals are non-productive assets. They generate no yield, no dividends, no cash flow. Therefore, they deserve minimal allocation, perhaps 2% to 5% of a portfolio. But this logic assumes stable monetary conditions. It assumes functional paper markets. It assumes trust in institutional counterparties. December 27th challenged all three assumptions. Sophisticated wealth managers are now asking different questions. Not what return will silver generate, but what happens to my client's wealth if the banking system faces a crisis? Not does silver pay dividends, but will my client's paper assets retain value if monetary confidence erodes? These questions lead to different allocation models. Models where precious metals aren't peripheral, they're foundational. Some institutional investors are now considering 15% to 25% allocations, not as speculation, but as structural hedges against systemic risk. The geopolitical dimension adds another layer. Central banks in China, Russia, India, and throughout the Middle East have been accumulating physical gold and silver for years, but their pace accelerated dramatically in 2024. These aren't investment decisions. They're strategic moves, building monetary independence from dollar-dominated systems, creating alternative reserve assets, preparing for a world where Western financial infrastructure may not be accessible or trustworthy. When sovereign entities behave this way, when nations with trillions in reserves shift asset allocation, they create price floors, regardless of technical factors or futures market manipulation, because they're not trading, they're accumulating, and they're patient. For business leaders navigating this environment, several principles emerge. First, recognize that we're in a transition period. The old system is breaking. The new system hasn't fully formed. Transitions are dangerous, but they're also where wealth transfers occur. Second, prioritize counterparty risk assessment. Every paper claim depends on an institution's ability to perform. Know who stands behind your assets. Know their exposure. Know their solvency. Third, maintain optionality. Don't concentrate entirely in any single strategy. Hold some physical metal. Keep some liquid capital. Preserve the ability to adapt as conditions evolve. Fourth, extend your time horizon. The cascade we're witnessing won't resolve in weeks. Structural transformations take years. Positioning for this requires patience and immunity to short-term volatility. Fifth, understand that this isn't just about silver or even precious metals broadly. This is about the revaluation of real assets relative to financial assets of tangible value, relative to paper claims. The business leaders who recognize this early, who position accordingly, who build resilience into their capital structure, will navigate the transition successfully. Those who assume the old system will simply reset, that paper markets will return to normal function, that prices can be resuppressed to previous ranges, are making a dangerous bet against evidence that suggests fundamental change. The sell wall didn't just collapse. It revealed the hollowness behind it. And once that revelation occurs, once market participants see the structure clearly, rebuilding trust takes more than algorithm. It takes time and credibility, neither of which can be manufactured quickly. So the strategic question isn't whether silver reaches $100 or $120. It's whether you're positioned for a world where paper promises matter less and physical reality matters more, where institutional guarantees carry less weight and sovereign possession carries more, where financial engineering faces limits and tangible assets reassert their value. That world is no longer theoretical. It's emerging in real time, and the decisions made in the coming weeks and months will determine who adapts successfully and who becomes a casualty of their own outdated assumptions. The wall has fallen. The cascade has begun. The question now is where you'll stand when the dust settles